accounting procedures, accelerating the financial close process, enhancing management and ownership dashboards, all automated through technology, which we also help to implement. You'll learn a little bit more about me and the panelists as we get into this, but given how much we have to cover, I'll jump right in. So I'm going to go to each of the panelists, ask them to introduce themselves, but before we get to the next one, I'll throw out a question. So Lance, let me start with you. Why don't you just tell us a little bit about yourself and your company?
My name is Lance Holman. I'm president of Holman Capital Corporation. Our company is a direct lender to state and local governments. There are about 130,000 local governments in the United States. And we finance their equipment, infrastructure, facility, and energy needs. I spent 16 years at some of the largest banks, JP Morgan, US Bank, and SunTrust Bank. And in December of 2009, while working at SunTrust Equipment Finance, I pitched an idea to my boss, and I said, we finance the equipment only of large public agencies across the United States. Why don't we set up a new unit that focuses on smaller and medium-sized public agencies and not only finance their equipment, but also their infrastructure, facility, and energy needs? And the bank said, Lance, this is 2009, that's a great idea, but we're not going to do it. I was 42 years old. I had about $500,000 in cash in my pocket, and I resigned and set up Holman Capital Corporation. I knew how to originate deals. I had the relationships, but what I was lacking was access to capital. It's primarily a bank product. I looked at the banking landscape and said, I can't sell to the largest banks. I'm going to sell to community banks, specifically community banks that do not have a public finance department. So if you can imagine a full service department that plugs into a community bank, and we originate the deal, we underwrite it, we price it, we document it, and we assign it over to that community bank partner. We not only help with escrow and client management post-closing, we stay with the client throughout the relationship, and we are the face to the community bank.
Thank you, Lance. I think in your description, you may have disclosed your age.
Yeah, that's fine.
No issues. Your company, obviously, in some of the genesis of it was to serve an underserved market as relative to your competitors. How are you competing against these much bigger competitors? And why can't community banks do this themselves?
Well, as far as the larger partners or banks are concerned, or competitors, you do what they don't do. They focus on the largest clients. They focus on equipment only, and you become full service to those small and medium-sized clients. We've built a database of all the decision makers in the states that we operate in. We do email campaigns. We do thought leadership. We write white papers. We, quite frankly, give them a world-class solution. And if you are giving your clients the time and the attention and the results, they'll come back and want to do business with you.
That's a good lesson. More questions will be following for you, Lance. But let me turn it over to Will, if you're there. And Will, can you hear me? Good. Why don't you tell us a little bit about your company and your story?
Perfect, thanks. So Will Stringer, co-founder, CEO at Chisos Capital, and we invest in early stage entrepreneurs using a convertible income share agreement. So I'll kind of dive into that, but just quickly, my background, I spent 4 years at a large family office in Houston, Texas. So have a bit of background kind of on the other side of the table here. So the convertible income share agreement is really a mix of two instruments. It's an income share agreement directly with the founders. And that income share agreement looks almost exactly like the income share agreements used in the education space. So for the past 5-6 years, income share agreements have been used at coding boot camps or even traditional universities as an alternative to student debt. It's basically a percentage of income that is paid back over time that fluctuates up and down depending on the earning power of the individual. And so what we've done is taken that instrument and modified it for use with early stage entrepreneurs. So what we do is we invest $15,000 to $50,000 checks in early entrepreneurs as they're starting their companies. So the instrument is income share agreement with the founder and then a safe in their business, providing us as the investor with downside protection through the income share agreement, as well as cash flow through the income share agreement, and then uncapped upside in a large portfolio of these early stage companies where we're getting in often, before even pre-seed investors come in. That's a little bit about Chisos and how we invest.
Thank you. I have a question for you, but before I even get into my standard question, do you think that any part of student debt is going to be canceled or forgiven per our new political leaders?
I'm in no position to be able to comment on that. I think from our standpoint, as we do monitor that, it would be beneficial for us because when we invest in these entrepreneurs, we're doing a bit of credit check and credit background work on them, and a lot of them have some student debt. And so it actually benefit us if they did have some of their student debt canceled. It would make them a better credit, which is only beneficial to us. So that's my view on it.
Diplomatic. Thank you. You worked at a family office, as you mentioned, and learned some of the pitfalls of their investing practices, especially as it relates to early stage entrepreneurs. How should investors and allocators think about the return profile of convertible ISAs? And just so people recognize income share agreements.
Yeah, we really designed the instrument using my experience at the family office, keeping that in mind, which led us to design this downside protection and cash flow, which we valued at the family office that I worked at, but also gives you that exposure to the equity upside. So exposure to the technology and the venture and the startups, which is a really difficult space to play correctly. It's hard to go direct. A lot of the top managers are hard to get into. And so what we've designed is the ability to really get a broad index of exposure on the early startup venture side of things. But where we differ is where we have a portfolio of, say, 250 investments. In a traditional venture strategy, say a third of those, go to zero or fail to return, 1x in capital. In our model, the equity can fail and the income share agreement will stay in place with the individual. And so our downside and our risk return profile is skewed quite a bit to the upside to give us that, call it 20 to 25% target IRRs. And then to your question about thinking about the kind of return profile of the asset. So the income share agreements alone, like I mentioned, a little bit separated from the equity. Those income share agreements alone are about a 12 to 15% returning asset. And then the equity component that is layered on top adds another 8 to 10% of return to get up to those gross target returns.
Okay. The equity layered on top, I'm sorry, is that the convertible function?
So the convertible function, without getting too far into the weeds, there's some elements whereby if the founder continues to raise money, raises institutional capital, we will reduce or convert some of the income share agreement into equity. And so that's where the convertible component comes from, but there will always be those two instruments that remain outstanding.
Okay, thank you. Zack, I have you next. Please tell us about yourself and your story.
Thanks, Ben. And thanks, Marty, for having me on again. I always enjoy talking to your audience and helping to educate them on on what we're doing in other areas of the market as well. So I run a venture debt fund, and this is a very exciting strategy. That's one of the fastest growing in the entire alternative space. Even just 2 years ago, most people I talked to about it didn't really understand the strategy and had a lot of misconceptions. And now that's changed immensely with some of the smartest investors in the world coming into the asset class. So the timing is great for us. So I wanted to talk a little bit about what the strategy is, because I think a lot of people still are unfamiliar with it. So essentially, it's a way to access innovation as an asset class through debt rather than equity. So instead of investing on the equity side through VC funds, you can invest with us and access the same companies, but through debt. And so essentially what we do is we make term loans, typically 3 or 4 years in maturity, to Series B, C, and D venture-backed companies. So these loans are made to companies that have already gone through typically 3 to 5 rounds of equity financing and are supported by some of the top equity VCs in the world. And we come in after they've done an equity raise, and we're providing them with additional capital that they're using for growth. And the benefit for the founders and for their equity investors is that it's less dilutive capital. So it's debt. So the debt portion is non-dilutive, of course, but we also have equity warrants attached to all these deals. So essentially, the borrowers are using it for growth capital. They've already reached their expansion stage, and they're just looking for cheaper capital to reach their milestones faster, so they can eventually exit the company for big numbers. So just for context, the strategy has been around for probably 20 years or so in its current form, mainly popularized by Silicon Valley Bank, and I'm sure anybody in venture has worked with them. But really in its current form, it's morphing. And so what we see is there's a lot more companies coming to market that are looking for venture debt. So we're seeing immense deal flow, just immense deal flow. The typical yields on the strategy are 15% roughly on the debt side, and another 5% annualized through the equity warrants. So historically, the strategy has kicked off 20% plus per year through multiple cycles in the market, including the credit crisis of 2009. And the loss rates are extremely low. Actually, the loss rates across the industry are less than 25 basis points annually. So less than a quarter of 1% each year. So essentially, we've got the best risk-adjusted returns in the entire space, much better than VC, much better than private equity, better than real estate, leaps and bounds better than public bonds or public equities. So essentially, I'm here to talk about what the strategy provides to LPs. But the way I think about it holistically is you're looking for yield and you're looking for protection of capital. The market's at a peak, or we don't know if it's at the peak yet, but it's very overvalued in some respects. So if you look at the S&P 500, it's trading at 45 times earnings versus 17 times historically, if you look at the PE ratio. So what that means is you could lose 25% of your stock market value tomorrow. The market could drop like it did in 1987, and it would still be 2 times its historical PE ratio, right? And then we see things that are crazy in the VC space on the equity side as well, with valuations up 50 to 150% year over year. That's the range, right? So the low end companies are trading 50% higher year over year. The high end about 150% for the same companies, right? It's just valuations are extreme. And of course, you've got specific examples of the extreme valuations with meme stocks like AMC. And we saw a company called MicroStrategy borrow $500 million at 6.25% just to buy Bitcoin, right? No structure around it, no strategy. Just we're going to borrow $500 million to go buy Bitcoin. And so those are your alternatives. So if you're interested in technology-enabled companies, you're interested in innovation, which you should be, because that's where all the gains are being generated. You should really think about playing it from the debt side, where you can clip 15 to 20% annually, but have very low risk.
So you're saying that we should sell stock and buy venture debt?
I'm saying that's what the smartest investors in the world are doing. I don't know what you can make your own mind, right? But I am saying that I was at the largest pension conference in the country 2 weeks ago, with 500 people in person in Texas, hundreds of billions of dollars of assets, and nobody's talking about buying equities, right? Like you get booed out of the room. I mean, what they're talking about is the move to alternative assets, and what they really love is private credit right now.
So if venture debt is one of the fastest growing segments, yet maybe many people on this call or in this forum are not yet familiar with it, but they may think of it in a different manner. How are you de-risking the chances of default?
Yeah, that's a great question, because it sounds risky. You hear the word venture and the first thought is it must be risky, but the data shows that it's not. And I'll explain the mechanisms that de-risk it. Essentially, you're lending to companies that are some of the fastest growing companies in the world, that are backed by the smartest VCs in the world, and have already gone through typically 5 rounds of financing. They've done an angel round and a pre-seed round and a seed round and a Series A and a Series B. They've raised millions and millions of capital. And we're coming in as a lender, senior secured, with a blanket lien on all their assets. So essentially what we lend against are a couple things. One is enterprise value. And typically we're lending about 10 to 15% of enterprise value, right? So if the company's got a $100 million valuation, we're lending them maybe $10 million. So even if the company hits a snag, there's a really thick cushion and a margin of safety there. We're also lending against the cash that they've just raised in their most recent round. So we always come in after the equity raise as more growth capital. So if they've just raised $40 million, we would typically come in, I'm just using this as an example, and lend about 25% of the last equity raise. So if they just did a $40 million Series B, we'd come in with a $10 million term loan. So we've got a lien on their cash, and there's covenants in place that are typically geared around minimum liquidity, the cash requirements that the company needs to maintain, and also performance to plan. So if their revenue falls by a certain amount, that'll trip the covenant as well. So these are very tightly monitored deals. So you think about it, the enterprise value, you've got LTV of 10% typically, right? You've got an LTV versus the cash of 20 to 25%. And then additionally, we're lending to companies that have recurring revenue, because most of these companies are tech-based, and a lot of them have a big software component. So they often have recurring revenue that's contractual in nature. Think about if you sign up for a software system and you sign like a 3-year contract, and you're paying for 3 years, and you can forecast your revenue. So typically we never are lending above, we don't like to lend above 75% against annual recurring revenue that's contractual. So if you think about it in those terms, you can see you've got massive asset coverage from the enterprise value, you've got cash, which you've got a lien on, and you've got control agreements in place with the bank account. So if things go wrong, you can literally take the keys to the company and as much cash as you need to make yourself whole. And then of course you've got this recurring revenue that with most of these companies is growing at 50 to 200% year over year on average. I mean, these are not slow growth companies, they're the fastest growing companies. And then lastly, if for some reason you're not able to rectify a problematic credit very early in the process, which you are almost the majority of the time, you also have a sponsor group of equity sponsors that have put much more money into the company and much more time and effort than you have, and also have a lot of reputational risk. So they're very incentivized to inject more cash into the company and bridge them to some kind of asset sale or exit. So this is why historically venture lenders just don't lose money. I mean, you can look at the stats. It's publicly available in the 10Ks of Silicon Valley Bank and 3 BDCs that are publicly traded that specialize in this. The numbers back it up.
Thank you. Tim, I'm going to turn to you, and I know that you were a venture debt lender, so I am interested to see if you agree with Zack's assessment that venture debt investors don't lose money. But before we get that, let me hear about yourself.
Yeah, Tim Barnes. I'm actually based in Southern California. For the last 3 years, I've been running my own firm, Access Group Ventures. We're an independent financial consulting firm focused on providing debt capital advisory, sourcing, restructuring services, primarily for growing innovative businesses that tend to be either venture-backed or founder-controlled. I've worked a wide range of credit products, everything from early stage to late stage venture debt, senior mezzanine, to middle market cash flow lending, to middle market mezzanine, to asset-based lending across AR inventory equipment, to structured products in the fintech landscape. So have a kind of a diverse background, a lot of relationships with private credit funds, BDCs, family offices, banks, and commercial finance companies. So as a student of the credit markets, just fascinated to connect with the panel and this group here, and continually learn on opportunities. Prior to starting my own firm, I did spend over a decade as a venture lender at Silicon Valley Bank and Hercules Capital. I spent 9 years at SVB, and then a couple years at Hercules Capital. So had a good background lending to mostly venture-backed companies, but some private equity-backed and public companies, early stage, late stage, both on the bank and non-bank side.
And did Silicon Valley Bank or Hercules have any significant default rates at any period of time that you were working there?
Yeah, so high level comments. I will definitely agree that the venture debt, venture ecosystem is a high growth, exciting segment. There's definitely been a wide range of new capital offerings provided in market from early stage seed, Series A stage companies all the way up to kind of late stage venture backed competitors. I mean, the market has gotten more competitive. There's a lot of larger alternative credit investors that will lend into the venture ecosystem. In my experience, it is challenging. There's with folks that do debt investing, it's different than equity. There's a lot of hands-on portfolio management, hands-on activity with businesses, and if you look at statistical venture capital equity returns, I mean, some of the equity funds generate substantial returns through a couple hits from their portfolio, and then there's certainly a decent amount of equity portfolio companies that unfortunately fail. I mean, that's the reality of the venture market. A lot of these equity investors are aiming for bigger risks, and so if you're a debt lender, it can be challenging. And I'll just say statistically, I mean, there's very few banks, commercial banks out there that lend into the venture risk segment. And then on the non-bank side, there are growing specialized firms, but it's still a challenging market. I mean, I've seen big shops like A.R.I enter the market and struggle and sell off a portfolio in the venture space. I mean, there's definitely firms that do it well, and there's firms that dip their toe into the market, and if there's a speed bump or a downturn in the tech segment, they'll exit the segment. So it's continually evolving, and there's a lot of opportunities. I mean, there's substantial equity upside returns, and I would say to kind of the risk mitigation and minimizing losses is a lot of the venture debt investors have made substantial gains on equity investments. And you can check public filings of some of the firms. I mean, one that comes to mind, there's a firm called CrowdStrike that IPO'd maybe a couple of years ago. Triple Point Capital provided a late stage venture term loan to the company. And you can look at public filings. I mean, it's a substantial equity return on their investment. So there's a lot of upside opportunities in venture debt where you get these equity kickers that can help minimize the losses in the portfolio and then drive higher yield. And interested in furthering the conversation here.
Hey, Ben, can I just make one quick point? I just want to be very clear. I'm not saying there's never any losses, right? So please don't take that out of context. I'm saying the losses are incredibly low, and this is all publicly available. And I'll give you a stat, and you can go look it up. Hercules Capital, that Tim used to work for, along with SVB, Hercules has deployed over 11 billion in capital since 2005, and their annualized loss rates are 4.5 basis points, less than 5 basis points. Hopefully everybody on this call is sophisticated enough to know what that means, but that's basically negligible losses, but that's lower than investment grade credit. And I've traded over 50 billion and executed over 50 billion in debt. And I can tell you unequivocally, this has the best risk adjusted returns of any debt asset class that I've been in. And I underwrote debt during the credit crisis at Scotiabank in leveraged loans. I was a trader at Deutsche Bank, and we were 2.8 trillion in assets and the biggest bank and #1 bank on the street in fixed income. And I was at an $800 billion asset manager at Sun Life. And I can tell you, venture debt blows that away. And just one last comment, in the current market, the deals that I'm seeing typically have a 12% cash interest plus or minus. They have a point upfront for underwriting fees. They've got back end fees of typically 5 to 6 points on average. And they've also got 5 to 10% warrant coverage. That's literally sitting on my desk right now. I've got 15 deals I could do that are all backed by top tier VCs that will print at 15% all in plus. So that's just the current market. And just for what it's worth, we just hired the lead PM from Oryx Growth Capital, which anyone in venture debt is very familiar with. They're one of the top 5 non-bank venture lenders in the country. They've been doing this for years. Our PM deployed, while he was there, they deployed over $2 billion in capital on 175 venture loans. And this isn't publicly available, so I can't share it with you, but suffice it to say, the losses on their portfolio were extremely, extremely low, in line with the peers that I've mentioned. So I can tell you, I know the results from the Oryxes of the world and the WTIs, and certainly all the publicly traded companies, and they're all in line. And you can look up SVB's losses, and they're higher because they underwrite everything in the space. And even SVB has averaged about 25 basis points in losses over the last 10 years.
Lance, I'm gonna go to you next. Zack and others are talking about 20+% returns, including equity kickers. Obviously, you're investing and focusing on a different asset class. What type of returns are you targeting, and where does that fall into the risk profile?
I would relate mine to closer to treasuries. And in the municipal bond market, you can probably get 1 to 3% returns tax-free. And then you have to convert that to its taxable equivalent. In the private debt market, you're probably going to do 2 to 4% tax-free. So on a taxable equivalent, that's 333 basis points to roughly a little bit over 600 basis points. But if you really think about how the United States government is structured, you really have 3 layers of governments. You've got the federal government, which is effectively the rule maker and the bank. And then you have the state governments, which are effectively regional administrators. Finally, you have the local government, which are the implementers and the first responders. So you have to ask yourself the question, can the federal government do anything nationwide without the first responders and the regional administrators? So I would say that the regional administrators and the first responders are an offspring of the federal government, and you can pick up 200 to 400 basis points tax-free by investing in this asset class.
How are you, where do you compare against other forms of municipal lending? I'm not sure you answer that in your question, just for my knowledge.
So you've got municipal bonds.
Yeah.
And municipal bonds, they do general obligation bonds and they do revenue bonds. In the municipal lending world, or the private debt world, we call them lease purchase agreements, which is an obligation of the general fund. And then we on the enterprise fund side, we call them installment purchase agreements, but effectively they're revenue notes. And so we do the exact same thing, lending capital to public agencies, but we just focus on these smaller and medium-sized clients that have really strong balance sheets that are not in Los Angeles, but in the communities surrounding Los Angeles or in rural parts of the United States that still need a fire truck, a fire station, a new school, a water treatment plant. And a lot of these deals are $1 to $30 million deals. And the client doesn't want to go to the capital markets because you've got so many more participants and it takes so much more time to issue a capital market deal. And it doesn't make sense to do that when you're doing a $1 to $30 million transaction. You can issue it much more quickly, lock in your project cost, by going into the private debt markets. The private debt market is efficient, it's quick, it's well organized, and a lot of capital, attested by the largest banks in the world being the major players, is truth to that fact.
Thanks, Lance. You know, you can tell from this panel that we have a wide range of alternative lending strategies that cover a number of different risk profiles. Will, I'm going to turn the next question to you, is that because you're focusing directly on the entrepreneur, maybe as opposed to municipal bonds, you know, venture capital, great venture capital backed venture debt. How are you even doing due diligence on these founder companies, and how many do you need to make your investment thesis work?
Yeah, so we're very technology focused. So my co-founder has 12 plus years in software and hardware, as well as managing a little bit of family capital. And so he's done a good job of helping us really build a technology-focused diligence process. So we have an open application online. We have our opportunities come through various sources, and we automate the front end of our process to where we're getting data, credit data, we're getting some psychographic, qualitative information on the founders, and then they're also submitting information on their business. And those three buckets is really what we look at holistically to come up with an opportunity score. So credit piece for the ISA, founder piece, qualitative psychographics, and then business, kind of high-level venture type diligence. And it's really only the high-level venture diligence that requires kind of the manual review to make sure that documents are in order, to make sure that the thesis is there on the business. And once we review all that information, that's how we come up with the score. The score then stack ranks our opportunities so that we can make investments at scale and efficiently. So again, with our next fund, looking to make about 250 investments over 2 to 2.5 years.
Okay, and just what kind of tech? Maybe is there a name for the technology that you're using to monitor the 250 investments? Is that proprietary, or where are you getting that from?
Yeah, it's a kind of a mix of proprietary and other service providers. So we've really built a lot of our software in-house to source, underwrite, and service our investments. And so sourcing, underwriting, I kind of talked about. On the servicing side of things, we have the payment processing and compliance side of the income share agreements. And then we also have the equity portfolio monitoring for the equity components. And really, as we see the opportunity at this earliest stage, right at friends and family round, maybe a little after friends and family round, but before pre-seed, there's a huge opportunity here, not only in the US, but globally for these entrepreneurs that need this capital to prove out their MVP or get their prototype to market. And so we see an opportunity to really take our software to maybe foundations or universities and help them set up their own convertible ISA platforms to increase the amount of these small dollar checks that are getting to entrepreneurs. So today we're the investment manager. We're raising our own funds, deploying our own capital, using our software. But really the broader goal here, because these are small check sizes at high volume, is to open source the terms and then help other investment entities really set up their own programs, whether they're targeting founders in a specific city or founders of a specific demographic. There's a whole lot of opportunity here in this unmet capital funding space.
If you are not outsourcing operations, you really need the partner to guide and support the success of your business and the soundness of your people. Aspen is here to support you. We are a full service outsourced HR benefit, payroll, employment management, and risk solution.
I have a question for you. Well, just real quick. So you're talking about like the software being usable. Is it possible like there could be a marketplace made out of your strategy? Can you talk about that?
Absolutely, yeah, and that's in our long-term roadmap. Again, we've got the asset management business where we're deploying capital, and then the software, we have a developer on staff to continue refining our technology. But the broader goal is really to pull together the opportunities using our terms, convertible income share agreements, and the investors to really start making a marketplace. And there's a whole lot of compliance and work that goes into that, so that's much later down the line, but start to look like some of these equity crowdfunding platforms that are popping up, like Republic or WeFunder. And really, again, it's all in the theme of democratizing access to entrepreneurship. The numbers on entrepreneurs and entrepreneurship are way up. A lot of it this year was due to the pandemic. People just realizing, hey, I don't like what I'm doing. I want to go start a company. There's a ton of opportunities in technology. And so, yeah, the space is massive, and there's a huge need for capital at this early stage.
Great. Thanks, Will. You know what I'm getting from some of these answers? This is hard. And Tim, with your background, I want to direct the next question to you. You know, why can't family offices that are at this forum or other investors do this themselves? What are the hurdles?
Yeah, great question. And I'll just comment that through Marty's ecosystem here, me personally, I've been fascinated to meet family offices that actually do very unique credit investing strategies. I will say it's definitely challenging, and not necessarily the right thing to do for some family offices. But I have seen both very large and smaller family offices take on unique credit investing strategies in market. Maybe a couple things that are required. I mean, you got to find a team. Some situations the family office themselves might have a DNA talent in a specific niche of the market to be comfortable providing alternative capital. I've seen other family offices have close relationships that lead to an investing strategy. So you got to have the right team. Alternative credit investing is definitely a hands-on sport. You're monitoring the portfolio more frequently than equity investments. You're managing loan documents, managing financials, collateral audits, a range of things that just require more hands-on infrastructure, team, compliance tracking, just a lot of things. And then you just got to figure out, what are your goals for returns? I mean, if you're thinking about launching your own strategy to generate a 15 to 20% current pay, well, there's a certain risk profile of deals in market that are structured priced at that. If you're going in market, wanting to manage a strategy that's a 5-7% or 5-10%, that there's a certain risk profile for those deals. So I think you got to, if you're going to do it, find the right team, invest in the infrastructure. It's going to take time. I mean, it's not easy to source deals. It's not easy to build a track record. If you're a company, are you going to take capital from an unknown family office that's never done any deals? Maybe not, depending on the situation. So it takes time to build that track record, build the brand, build a reputation market. I've seen it done successfully across a range of products, and certainly open to any direct conversations to discuss further.
Ben, one thing I can add to that is what I'm seeing a lot of is family offices and other institutional investors, quite frankly, endowments and even some pensions that want to co-invest. So to Tim's point, the ability to build this internally, it's very low. Like it takes tremendous resources, right? Like it's not something you can just pop into and do a couple of deals. I mean, unless you want to lose a lot of money and spend a lot to lose a lot, right? It's that being said, what I think works best and what most family offices are doing with us, for instance, is thinking about how to co-invest alongside us, where we can do bigger deals and we won't underwrite the entire ticket, but we'll underwrite a big chunk of it and then give our LPs the ability to co-invest fee-free, right? And so they're basically getting all the things that Tim alluded to that are very hard to build internally, operational infrastructure and credit writing expertise, underwriting expertise. But they're also not having to do any of the work. They're basically just free riding, and they can, cherry pick where they want to gain more exposure. And what we're finding is a lot of LPs have specific areas of interest or expertise. So they might be very interested in AI, or they might be interested in fintech, or they might be interested in ESG related investments. And we can provide them access to those deals curated. So not only can they co-invest alongside us, but the deals that we don't do, which is 98% of the deals we see, we can show them and we can curate that deal flow for them. And a lot of times we see great opportunities that are better suited for equity investments because they're too early stage, they're not ready to support debt, but they're phenomenal equity opportunities, right? And these are the kind of deals that we show to our LPs so that they can benefit from that. And so they get that for free, right? So that's a huge, that's how I would play it as a family office. I'd find a manager that sees a lot of good deal flow, that's got very good process-based investments, investment processes and systems, and that can show you good deal flow and also show you specific co-investment opportunities that suit you.
Hey, Ben, I think Zach is spot on. I think that I would piggyback and say that it's important to have a couple of champions on your investor side, and you train them on the credit underwriting and on the documentation, because the client experience, how quickly, how smoothly, how efficiently does the deal flow through the process from originating a deal, and then you underwrite it, then you price it, you document it, and then you assign the deal over. You've got to also take into account the borrower. Does the borrower like doing business with you? Will they refer other firms to you? And if you think that entire process all the way from both the borrower side to the investor side, and you, meaning the service provider, are doing all the work, but they can verify the work that you have done and the process, then I think that you're going to be more successful.
Lance, you bring up a good point, so I want to ask you this. So we've talked a lot about the infrastructure that's necessary at all of your companies to make things tick. What is the most, and Lance, from founding your company back when you were 42, I believe you said, what is the most important infrastructure decision that you've made?
Credit underwriting, and then secondly, documentation. You really need to understand how to underwrite municipalities, how to underwrite population growth, the development of water systems. You really need to understand from the municipality's perspective all the way to the taxpayer or the ratepayer's view. And then secondly, you have to have legal counsel that specializes in what you do, and they can create a set of template documents for you. And then thirdly, you should automate as many steps in the process. So for example, on the credit side for us, 70% of the document is identical, it's the same document. And so 30% is customized. So if you automate 70% in a CRM and you push a button and it pops up, 70% of your credit underwriting is done. And then you customize the other 30%. On the documentation piece, if your attorneys do it right, 95, 96% of the document is automated. You push a button, you're spending 4% of your time on automating. What does that mean? It means speed and accuracy and a better client experience for both the borrower and the investor.
I couldn't agree with Lance more. I feel like you really nailed it. In fact, let's get together in LA because you and I think along the same lines. Everything you said is spot on. Having great processes to create a better client experience, right? And you've got your low touch processes that you can automate, and then you want to spend your time and effort on the high touch processes and making sure the client has a great experience. And Ben, I don't think you asked this specifically, but in terms of infrastructure, I think it's very important to work with the best service providers in the space that really are experts in your particular product, right? So when we approached it, we went with the best lawyers in the space. We worked with Paul Hastings on fund formation. We work with Cooley, who's obviously 40% of the venture market. DLA Piper, Thornburg. I mean, these are names that like Tim Barnes knows well. You've probably worked with all these guys. We work with the best lawyers in the space. We have Northern Trust as our fund administrator. We work with a Big Four auditor. Everybody we work with is top tier, and we selected folks that know this product, right? Venture debt is very different from other products. That's why it's such a great product, because it's an inefficient segment of the market that people don't understand, right? That's why I can generate alpha consistently. But having people who have worked in the space and who have worked together is critical. So the way I thought about it is, with our fund, everything is institutional quality. We brought together the best service providers who have already worked together on similar mandates in the past. So all I needed to do is take this killer strategy,
Like
and a
white
great team, and put it into the service provider.
Lance is like.
Sorry, Wendy, I don't know if you're popping up on my screen. But yeah, so just to wrap up, having great service providers and then pairing that with a great strategy and a team capable of executing is that, that's the recipe for success.
Great. Thank you, Zach. And I know that you asked Lance and some others to get together in California. I'm on the East Coast. So if anybody's in the Boston area, please contact me. Okay. I've got a great brewery we can go to and talk more. I know Marty said that there was only a couple of minutes left. So I'm going to ask one question to the panel. And then we can move on to the next one. So I know that we're somewhat tired about talking about what has occurred in the last year, the pandemic, COVID. I just mentioned those names, but I will not mention that again. But please tell me, what is the best opportunity that has been created for you and your business over the last year? Each of the panelists.
In my space, it's going to be infrastructure spending. The infrastructure bill that's coming out is really targeted to making America more competitive, but also putting lower skilled and middle skilled, middle income people to work and giving them an opportunity. America needs to revamp and compete globally. And if it has the same client experience with dealing with other countries, which means it too has to have the infrastructure in place, then we can compete with other countries that are beginning to dominate. And so I think that infrastructure spending and energy, primarily the movement to renewable energies, is going to be an opportunity to address a need and boost employment and keep America strong.
Yeah, Tim, I'll go real quick. I mean, I'm fortunate to play in the innovation ecosystem. So fortunate that there's a constant, flow of investment and need to invest and grow companies, more equity dollars, new innovative credit investment dollars. All that kind of creates opportunities for my business. Companies never go on a linear up into the right line in terms of their growth. Things happen. COVID happens. Different things happen in market where companies go through ebbs and flows, and it creates opportunities to provide trusted advice, support, and be a soundboard in situations. So always interested in networking. This has been a great conversation, and appreciate it.
Thanks. Will, Zach, anything to add on opportunities?
Yeah, I think just generally speaking, we've seen that innovation is really what's driving value creation. I mean, this has always been the case, but now more so than ever before, whether it's large cap or startups, all the gains are going to the innovative companies that are disrupting and shaping the future. So this has been a huge boon for venture debt, because ultimately there's many more talented founders coming to the market with great startups that are going to create tons of value. And so it's just a huge market. I mean, there's so much growth right now in the space that we don't even think about competitors. Yeah, I really don't. I'm not just saying that. Like, we talked about this yesterday on the Hedge Fund Association's venture debt panel, and this was with SVB, Oryx, and the Mass Development Fund that focuses on venture debt in early stage. And we all agreed, we don't need to compete because the pie is so big, I can take 3 slices and still come back for more. And that's really what's great about this industry right now, is it's being fundamentally driven by a need for capital, and banks aren't set up to do this outside of Silicon Valley Bank and a few others. They just don't know how to do it, and they can't get their heads around the model. So there's just massive alpha opportunities right now, probably for the next 5 to 10 years before they figured it out.
Yeah, I couldn't agree more with Zach on the innovation side of things. It's never been cheaper to start a company. Marry that with the fact that entrepreneurship is up. People are realizing they don't want to be tied to a city, especially if they're closer in my age than maybe some of the older brackets, and they want to work for themselves or go out on their own. And if they don't have wealthy connections or good connections to VCs or angels, a lot of times they're stuck. And that's where we're coming in and finding a lot of opportunity with really solid earners, ex-bankers, ex-managers at tech companies. But that trend of innovation and entrepreneurship is really where we're seeing huge opportunity.
Well, thank you. And who are you calling old?
Nobody. It was all relative.
No, thanks all. This was a great panel. As usual, a lot of fun. Really appreciate it, Marty. I'll turn it over to you.
Thanks so much, guys.